Okay, so I'm going to do some problems that are similar to what's going to be tested. They're not exact, but they're going to be similar to problems that will be tested in exam 2 for accounting 2022. Okay, so let's go ahead and get started. Let's look at problem number 1. It says the manufacturing cost of Calico Industries for 3 months of the year are provided. So here we have the 3 months, and here we have the total cost and the total units produced. And it says using the high-low method, the variable cost per unit and the total fixed costs are. So we need to find what the variable costs and fixed costs are using the high-low method. So the word high-low already gives you an indication of what you have to do. First thing you want to do is you want to look at the month with the highest or the month with the lowest, either two. You wanna see which are the 2 months, the one with the highest and the one with the lowest total cost, and of course production in units. So we see here that April has the highest and May has the lowest. So the June data is irrelevant to solving this problem. Okay, so here I put in bars more or less what we want to do. See, these are the costs of May, total cost over here, and we have the total cost of April. So what we're going to do is we're going to take advantage of this gap here, the difference that we see here. Since variable cost per unit is going to be the same, it's going to be consistent under all 3 months, we know that as the cost increase from this point to this point, each cost is going to be a variable cost, and so the number of units that were increased, in this case 280,000 minus 165, were what caused this increase in cost, right? So first let's determine what's the increase in cost. Let's put the months here. Let's write them down first. April is the high, so we'll go April, and it was $120,000 for 280,000 units produced. We could, and then May was the low, so we'll just put May here. 74,000 was the cost, right? So this whole thing here is 120,000, and this whole thing here, here is 74,000 in cost. Those are the total costs, what these bars represent, right? And we produce 165,000 units, right? So the extra amount of units will take 280 and subtract 165. The extra amount of units, 115,000 units, cause an increment in expenses of how much? Cause an increment of expenses of 120 minus 74, which is 46. So an extra 115,000 units cause an increment of $46,000 in extra expenses. So, and we know all that is related to variable cost, because the fixed cost is fixed. It's gonna be there even if you have 0 units produced. So the extra 115,000 units produce $46,000 in extra cost. That means that the cost per unit is going to be, you simply take the the $46,000. You're going to take the dollars, right? And you're going to divide them by the units, additional units. Not sure why I got that, but let's click yes. And so, as you can see here, the answer is 40 cents per unit, right? That makes sense. If you produce 115,000 units extra and your cost increased by 46,000, then it's going to be 40 cents per unit. So we already know the answer is B, because that's the only one that gives us the 40 cents per unit. At this point, we could just choose B and move on, but I still want to show you how we calculate the 8,000. So we've only calculated the 40 cents per unit using this, but remember fixed cost is down here. We need to isolate fixed cost from variable cost. So if I can use either one of these two to get that data, right? So I know that my variable cost is 40 cents per unit. Let me make these dollars so that we won't get confused here. Format cells. Okay, hopefully this won't take forever. Okay, so let's go ahead and sort of underline this. Let's make it easier on the eyes. So we could do it with either or. You don't have to do it on both. You don't have to do. They both should give you the same answer. Okay, so our variable cost is 40 cents per unit, and we produce 280,000 units. So our total variable cost for this would be simply 280,000 multiplied by 40 cents. Total variable cost, okay? Keep that in mind. I'm just calculating total variable cost at this point. So total variable cost is 112,000. I know that my total cost was 120,000 variable and fixed. So 120 minus 112 will give me my fixed cost of $8,000. And it should work the same way here. 165,000 at 40 cents is telling me that I have a total variable cost of 66,000, right? Which means my total cost was 74,000. So fixed cost would be 74 minus 66 is 8,000. So we got the answer for the cost per unit. If you didn't quite catch it, you can repeat this video various times, 40 cents. And we have the total fixed cost of 8,000. So clearly the answer is B for this one. Okay, let's move on. I'll try to make let's see if I could fit it all in one video, or I'll do various videos. There's 14 problems here that I'm going to do. Okay, so let's take a look at the second one. If sales are $500,000, variable costs are 60%, and income from operations is 190,000, what is the contribution margin ratio? Okay, what's the contribution margin ratio? So to answer this question, we sort of have to understand what the heck am I talking about when I say contribution margin ratio, right? So there's two forms of ways to present the income statement that we've been talking about, the absorption and the variable costing, right? So this is talking about contribution margin relates to variable costing method, not the absorption costing method. And in the variable costing method, what we do is we put sales, right? So let me do sales, and let me put a number here. Let's say sales is 400,000. This is the same number that I gave you in the review. 400,000. Okay, let's so this is sales. So sales as a percent of sales equals 100%. I'm not even gonna do the math because it doesn't make sense. 100%. Okay. So what's the next thing we're going to do? We're going to subtract variable cost of goods sold. Variable cost of goods sold is subtracted from that, and we are going to get, so let me just make up any number. This is just to show you the format. 120, 123, right? So variable cost of goods sold, let's take all this and let's move it over here so that it's easier to see the whole thing. Okay. And variable cost of goods sold is going to be what percentage of sales? Well, just so that we could have that information. 30% of sales. So from here, we could get manufacturing margin. Manufacturing margin. Manufacturing margin. Okay? So manufacturing margin is nothing more than the 400,000 minus the 120,000. Okay? So that's your manufacturing margin. That's just a calculation of sales minus variable cost of goods sold. But we still have another variable cost to subtract before we reach the contribution margin. Okay? And the other variable cost to subtract, these variable costs relate to all the variable costs that are put into the product. But you also have variable selling and administrative expenses, right? They're not related to the product, but they are variable. Variable selling and administrative expenses. Okay, so what are these? Let me just put a number here, and I'm going to make it very similar to the example that I gave you in the review. In that example, I put 100,000. And so what is this as a percent of sales? As a percent of sales, this is 25%. Okay, so from here now we could get finally to the contribution margin. Contribution margin. Contribution margin is nothing more than manufacturing margin minus the variable selling and administrative. In other words, contribution margin is sales minus all variable costs, cost of goods sold, and cost of goods sold variable expenses, and variable expenses related to selling. Okay, so in this case, the contribution margin is going, as it relates to sale, as a ratio, is going to be 45%, right? Sorry. It's going to be 45%. Okay? So, and that makes sense. Look at the variable cost. What's the total variable cost? The total variable cost is 55%. So obviously contribution margin is the difference, 45%. Okay? So they're giving us here the total variable cost of 60%. So if total variable cost of sales is 60%, then what is the contribution margin ratio as it relates to sale? Well, 40%, the difference, right? So the answer in this case would be C, 40%. So that's one that you do not have to do any type of calculations. You could just use logic and see it there. It's, if variable cost, total variable cost, this and this is 60%, then the contribution margin has to be 40%. Operating income is irrelevant to your answer, and even the sales of 500,000, that's irrelevant. You don't need that. If I tell you total variable cost is 60%, then you know that the contribution margin of each dollar that you sell is going to be 40%. Okay, so the answer in that case was C. Let's change this number here so that you can see. So if I make this number 120, 1, 2, 3, now I have a total contribution margin of 60%, total variable cost of 60%, and what's my contribution margin ratio? 40%, which is 100% of sales minus 60% of variable costs, okay? So that one was quite simple. Let's go on to number 3. Okay, so it says variable costs as a percent of sales for Lemon Inc. are 80%. Okay, so we could go back here and take a look at this, and so what they're saying is variable costs. They're putting both these together, and they're saying that it's 80%. Okay, if I do 150, what am I going to get here? 150, 1, 2, 3. No, not quite 40. I'm trying to get 40%. Nope. Okay, is that a perfect 40%? Yeah. Okay, so that would be like this. So I have 40% in this. It could be 20 and 60. It could be 70 and 10. It doesn't matter. But the total is 80% according to this problem, right? So it says variable costs. Let me go ahead and copy this over. That way I won't have to. Okay. So it says variable costs as a percent of sales are 80%. In this case, I put 40 and 40. It could be 50 and 30. It could be 60 and 20, whatever. But the total is 80%, right? It says current sales are 600,000. We make it 600,000 just so that we could follow this exercise. 1, 2, 3. Okay, current sales. I'm sorry, I messed this up because now I have to change. Now I have to change my variable cost number. I'll just figure it out this way. This times 0.4 equals 240. So it has to be 240. 240. It's 240 and 240. You don't have to do all this. I'm just putting the numbers so that you can visualize it. Okay. It says variable cost as a percent of sales is 80%. See, so we have 80% here, and it says current sales is 600,000. And fixed costs are 130,000. I'm not even sure we need this fixed cost. How much will operating income change if sales increase by 40,000? Okay, so we don't need none of this stuff. If you understand the problems good, you will know that if variable costs are 80%, then what's the contribution margin? Well, the contribution margin is going to be 100% of sales minus 80%, which is 20%, right? So each dollar in sale contributes towards fixed costs 20% of that dollar. So it contributes 20 cents for each dollar, right? Because the rest is going to be absorbed through variable costs. So if you sell $40,000, you know that 80% of that is going to be variable costs, right? You're going to have a variable cost of 32,000, right? And the remainder will go to your bottom line. Let's assume you already covered fixed costs with the first 600,000. So operating income change if sales increase by 40,000 is going to be 40,000 minus 32. Sorry. Minus 32 is going to be $8,000, right? So the answer to that would be an increase of 8,000. An easier way to do it is say, okay, my contribution margin is, I know if my variable costs are 80%, then my contribution margin is going to be 20%, right? If my contribution margin is 20%, that means that $40,000 is going to contribute how much to the bottom line? $8,000. Okay, so the contribution represents the amount of dollars, contribution margin, the amount of dollars that's going to go to your bottom line. First, it's going to cover fixed costs, and then it's going to go ahead and contribute towards increasing your operating income. Okay, and so in this case, how much will operating income change if sales increase by 40,000? Well, you're going to have an increase of $8,000. That's the amount of dollars that goes down to your bottom line after subtracting the 32,000 of incremental variable cost that this $40,000 in sales adds to your balance sheet, right? Let's put it right here. Let's say I add, well, I can't do that because I'll have to change all the numbers here. Yeah, let's do it over here since we have all the time in the world, right? Because this is a video. So let's go copy, paste. I want to make it a value. Can't remember how do you make this a value? Page values, okay? So now these are values, and so if my sales now is 640, my contribution margin, my variable cost is 40%, so this should increase by 16,000, right? $256. This one is going to increase by 16,000 equals this 40%. We started doing this backwards, right? This one increases by, so if I have sales of 640,000 and I have a 40% in variable cost, now my variable cost will go up, right? 16. This variable expense will go up another 16 for a total of 32 as we calculated here. And so the contribution margin goes from 120 to 128, and that all goes down to your bottom line. Okay? So that one should be easy. I know I over-explained these things so that you could understand the concepts because it's very important. But you don't have to do all this. The logic is very simple. Variable cost, the total variable cost is 80%. Therefore, each dollar contributes how much? 100% minus 80% is 20%. If each additional dollar contributes 20% to the bottom line, $40,000 is going to contribute $8,000 to the bottom line, $40,000 in sales. So your bottom line, your operating income will increase by $8,000, and the answer to that one is A. Okay, let's do number 4. It says, if fixed costs are $450,000, the unit selling price is $75 per unit, and the unit variable costs are $50. What are the old and new break-even units if the unit selling price increases by $10? Okay, so then the selling price was 75. That's the first one. That's unit selling price. Let's make this to make sure that we understand. Let's make it currency. Sorry, currency. And then the second one, it says it increases by 10, right? So the second one has to be 85. So what are the costs we want to cover? It says fixed costs are $450,000. So you're going to cover $450,000 in fixed costs under both scenarios. Remember, fixed costs are fixed costs. It doesn't matter. You could increase your selling price. That doesn't mean that your fixed costs are going to go up. They're going to remain constant. So these are fixed costs. So the answer becomes very easy, right? If each unit, the selling price is $75. So, and the unit variable costs are 50. So if the unit variable cost is $50, right? So we need to add another step. And again, do variable costs change just because you change the selling price? No, it's going to remain constant. So the unit variable cost is $50. So it's just logical that if you sell it for $75, the contribution of each unit is going to be lower than if you sell it for $85. You're selling it at a higher price, so if you could sell it for that price, you're going to get an even higher contribution. So each unit is contributing. In the first case, each unit contributes $25 to cover fixed costs of $450, and in the second case, each unit contributes $35 to cover fixed costs of $450,000, right? These are fixed costs. These are the unit selling prices. And this is unit variable costs. So each unit, let's call this the contribution margin. So under scenario 1, the contribution margin is $25 per unit towards fixed costs. Under scenario 2 is $35. So if each unit contributes $25, how many units do you have to sell to break even? Well, 450,000 divided by 25 equals 18,000. So for this one, the answer is 18,000 units. So far, B and C may be the answer. And then you do the exact same thing here. 450,000 units divided by 35 is 12,857 units. So the answer to that question is C, right? These are the break-even points in units. So it says, what is the break-even sales in units? Break-even sales units. And there you go. So it's quite easy. These problems, I'm over-explaining them, so they are taking a little bit longer than they should take you in the test. Once you understand these, you don't need to, all this explanation is not necessary. It'll come natural and you should get this done very, very quickly. But this is, you still have to do this math, right? You still have to subtract variable costs from selling price to get the unit contribution margin, and then divide total fixed costs by unit contribution margin to get break-even sales in units. Okay, so that's number 4. Let's go to number 5 of 14, and I might break this down into 2 videos. That way they are 2 short videos. I'm not sure. We'll see. Okay, Harley Company has sales of 500,000 and variable cost of 75% of sales. So we know that the contribution margin is 25%. Not sure if we're even going to make that. And operating income of $40,000. What is Harley's operating leverage? Okay, so in this case, this is simply a matter of memorizing a formula. Okay, so you go to your review sheet, or you go to your PowerPoint slides and you look up for the operating leverage formula. And it says operating leverage equals contribution margin divided by operating income. or income from operations, however you want to say it. Okay. So my operating leverage, what's my contribution margin here? My contribution margin is 25% of 500,000, right? So let's take 500,000 and multiply it by 500,000. And I'm going to go ahead and multiply that by 25%, 0.25. Again, don't really understand why it's, oh, I guess it doesn't like that, the comma in there. Anyways, so my contribution margin is $125,000. So what's my operating income? Well, it gives me the operating income. I don't even have to calculate it. My operating income is $40,000. It says it right there. So operating leverage is very easy to calculate. It's contribution margin divided by operating income, and it's going to be 3.125. So the answer to that one should be D. Okay, you just round it off to the nearest. Let me go ahead and put here contribution margin, because I might upload this to the web canvas. And we have operating income, right? And this is operating leverage. So there's your answer right there. Let's save this and let's move on to the next one. So far we're at 31 minutes in the video and we've covered 5 problems. This should take you, each of these problems should take you maybe, if you're prepared, it should take you no more than 1 minute per problem, to be quite honest with you. 5 minutes. Obviously, I'm explaining as much as I could here. So number 6, if the volumes of sales is 7 million and sales at break-even point is 4.8 million, what is the margin of safety? So what does the margin of safety represent? The margin of safety represents the amount of dollars that you can go down, or the percentage that your sales can go down before you hit your break-even point, right? So if we have sales of 7 million and we have break-even point of 4.8 million, how much is the margin of safety in dollars? Margin of safety in dollars represents, it's quite simple, right? Margin of safety in dollars is 7 million minus 4.8. So the margin of safety in dollars is $2.2 million. And so that $2.2 million, what this is asking it in a percentage basis. So what does that represent as a percent of sales? Well, that represents as a percent of sales 31.43%. So in this case, the answer to that question is false, right? It's not 45.8. 31.43% is the margin of safety. Okay? So margin of safety, I could do it the other way around. I could say these are sales and this is the margin of safety. I could either give you dollar amount or percentage amount and then ask you what's the break-even point. So understand how to, when you have various variables, I'm not going to present it exactly like this. If you understand everything, you should be able to understand how to answer the question. So if I say you have sales of 7 million and you have a margin of safety of 31.43%, what's the break-even point? Well, that's quite simple. All you do is you take your sales and you multiply it times 31.43%, and I'm sorry, you take, and then gives you the margin of safety in that gives you the margin of safety in dollars, right? So now you have the margin of safety in dollars, so now sales minus margin of safety in dollars will give you your break-even point. Okay? So you have to learn how to not just do it exactly how I'm asking the question, but if I switch the question up a little bit, you have to know how to adjust properly and still get the right answer. So let's do 7 and 8. A business operated at 100% capacity for its first month. So this is the first month. The reason they're telling you that is because they're basically letting you know there's no inventory in this business, right? Okay, and incurred the following costs. These are all the costs that it incurred. If units remain unsold, if 1,000 units remain unsold at the end of the month and sales total 150,000 for the month, okay, so they're giving you the sales. What is the amount of the manufacturing margin that would be reported in the variable costing income statement? In the variable costing income statement. Okay, so we know that manufacturing margin, let me look for that around here. We know that manufacturing margin, they're asking you for this here, not contribution margin, don't get it confused. Manufacturing margin, which only excludes the variable cost of goods. These are only the variable costs that pertain to product costs, right? So you don't have to worry about the variable costs related to selling and administrative expenses, okay? So, and you see here, here you have variable operating expenses. You don't have to worry about this because they're asking about manufacturing margin. So we're only going to worry about the variable costs that go into the products, okay? And it's asking for variable costing. So we know that under absorption costing, all these go into the product cost, but not under variable. Under variable, we only include we exclude fixed factory overhead. Fixed factory overhead goes down as part of the as the selling and administrative expense in total, okay? So under variable costing, we're going to include variable costing. And look at the review sheet, because I told you I show a comparison of what to include under product cost, under variable and absorption costing. So under variable costing, we will include the 70,000, right? So total product cost under variable costing is going to be 70,000 plus 20,000. All these are part of product cost plus 10,000. So my total variable cost for this is 7. Okay, so my total variable cost is $100,000, and it says that I sold 150. So if sales are 150,000, right? And if 1,000 units remain unsold at the end of the and sales was, what is the amount of the manufacturing margin that would be reported under variable costing? Okay, so what's the cost of good manufacture? Cost of goods sold. Sorry, goods sold. Let me make this more specific. Variable cost of goods sold. So So you have to do a little bit of math here, okay? So your total variable cost was 100,000. How many units did you produce? You produced 10,000 units, right? 10,000 units. So what's your cost per unit? Your cost per unit is going to be equal 100,000 divided by 10,000 units, right? So you have a cost per unit of $10. It says if 1,000 units remain in inventory. So that's a clue there. 1,000 remain, you didn't sell 1,000. So how much you sold? You sold 9,000. If you sold 9,000 units and each unit has a cost of $10, your variable cost of goods sold is going to be 9,000 times 10 is 90,000, okay? So we finally got to the variable cost of goods sold. So the variable cost of goods sold is 90,000. How much stay in inventory? Well, 100,000 minus 90 is 10,000. 10,000 stays in inventory of the whole 100,000, and 90,000 is recorded as a variable cost of goods sold because you sold that much in as far as product cost goes, right? So what's your manufacturing margin? Is 150 minus 90 is $60,000, and so the answer to that one is C, $60,000. We'll call this the manufacturing margin. Remember, we will have problems like this on the test. So just watch this video till you understand it. It's not that difficult. Maybe the first time it's hard to grasp, but it's not that difficult. Okay, so this one here we see, well, I already explained that, right? Using the data above, what is the amount of inventory that would be reported on the variable costing balance sheet? Well, you sold 9,000, but you created 10,000, right? So if you're only going to put as part of your cost, which goes in the income statement, whatever you sell. So you sold 9,000. You know that the unit cost is $10. So your variable cost of goods sold is $90,000. What do you have left over that you haven't sold? Well, 10,000 that you produce minus 9,000 means that you have 1,000 left over. And that amount is not going to be expense yet. We're simply going to put that as inventory, 1,000 at $10 each. So our inventory is going to show that we have $10,000 in inventory. Okay? So of the $100,000 in cost, we expense 90,000 in our income statement, and we put 10,000 in inventory to be expensed in the future when we sell them. Okay, so let's move on to problem number 9. Problem number 9. In this problem, the key here is to focus on this area here, on fixed unit manufacturing costs. Why do we want to focus on fixed unit manufacturing costs? Because that's the only area that creates a difference, that has a difference between fixed and variable costing. If you go to the review sheet or to the PowerPoint slides, you're going to see that under variable costing, variable costing and absorption costing. Absorption costing. Okay? What do we include in product costs here? We're going to go ahead and include we're gonna, let's do this just to make it nice. Okay, so what do we include in variable cost? We're going to include direct materials. We're going to include direct labor. And we're going to include only the variable portion of factory overhead. Okay? The fixed portion, fixed factory overhead, is going to expense entirely as a period cost when we use variable costing. Okay? Under absorption costing, we're going to include as product cost direct materials, direct labor, variable factory overhead, and fixed factory overhead. So both of total factory overhead is included under absorption costing. Okay? So this is key in understanding. Period cost here, as far as factory overhead goes, is non-applicable. Okay? We're going to put it up here as part of the product cost. So this is key in understanding these type of questions. It says, what would the effect on income from operations if absorption costing is used rather than variable costing is used, right? So the difference here is only going to be caused by fixed factory overhead, units of manufacturing cost of the period that are fixed. Okay? So we have units of manufacturing cost of the period that are variable, that would be this, and units of operating expenses of the period that are variable are these, right? And so this is the only area that causes a difference between both of them. So we're going to focus on this area here, fixed units manufacturing cost of the period, because under variable costing we expense them entirely, and under absorption costing we put them as a part of the product cost. So if we have some units that are left over, then this portion here is going to go into inventory under absorption costing, but will not go into inventory. It will be expensed entirely under variable costing. Okay? So it says the level of inventory of manufactured products increased by $8,000. So we had an increase, 8,000 units. So 8,000 units stayed in inventory, right? So how is that going to affect variable costing as far as fixed factory overhead goes? It's not going to do anything. It's not going to affect fixed factory overhead because this is expense entirely, right? So, the question is how much of this expense is going to stay in inventory? None of it is going to stay in inventory under variable costing because it's all expense entirely as a period cost. Some of it will stay under absorption costing. So how much is going to stay? Well, we know that inventory increased by 8,000 and that the unit fixed manufacturing cost was $10. So under absorption costing, we are going to have $80,000 of fixed factory overhead, which is this one here, that is going to stay in inventory. It's not going to be expensed, which means if it's not expensed, it means that absorption costing will have higher income, right? Because you left $80,000 of fixed factory overhead in your inventory account. You did not expense it. Variable costing's income will be lower. So let's see what the question is. What would be the effect on income from operations if absorption costing is used? Well, if absorption costing is used, I'll be able to put $80,000 of my fixed factory overhead into inventory rather than expense it. So it's going to be an increase of $80,000. The answer would be B. Okay? So I really want you to understand the whole logic behind all of this. But if you don't understand the whole logic and if you panic in the test, just remember, this is the only data that's truly important for you. Fixed at $10. There's an increase of 8,000. So that's $80,000 difference between one and the other. Okay? Under fixed, if there's an increase, that means that absorption will have lower expenses because under absorption you get to put this in inventory, and so it'll have higher operating income, right? If they have lower expenses, then logically they're going to have higher operating income. And so if you use absorption costing, you'll be able to increase your operating income by $80,000 simply by producing 8,000 more units that you might know is going to stay in inventory. Okay. Let's see number 10. I have a total of 14, so we're getting there. Hang in there. Obviously, you could put this on pause or you could stop it and come back later. So again, we have another similar problem here. We already know that we want to focus on this 10. It says the level of inventory of a manufactured product has increased by 5,000 units, okay? So I'm going to try to do this the simple way, see if it helps you. So I know 5,000 units is what it increased, right? If you don't understand the logic, just go back to the other problem. So that's the increase in units. Increase in inventory. Okay? And it says the following data. We know that the difference between variable costing and fixed costing is going to reside here. So let me just put the $10 here. I'm sorry. $10 per unit in fixed cost. So I know that under absorption costing, I got to put this much in my inventory. Let's see if that's the question. I don't know if that's the question. So if I put 50,000 in inventory, I know that absorption costing is going to be greater than variable costing by $50,000 as far as operating income goes. But I don't really know if that's the question yet. Let me complete the question. What will be the effect on income from operations if variable costing is used rather than absorption costing? So you need to understand the perspective of the question, right? So now we're talking variable variable costing rather than absorption costing. So variable costing as it relates to absorption costing will be $50,000 less. $50,000 decrease. The answer to that would be A. Pay a lot of attention to the question because this exact same problem is given to you, and if I say what will be the effect on income from operations if absorption costing is used rather than variable, then you do the exact same thing to get the answer, but then the answer becomes a $50,000 increase because I'm asking you about absorption costing, right? And absorption costing in this case would have $50,000 greater operating income than variable costing because you're able to put $50,000 in your inventory of fixed manufacturing overhead rather than expense it. Okay, so these are the two key figures: the 5,000 increase, the 10,000 focus on this top corner here, and that's the difference between variable and absorption. You know that if inventory increases under absorption costing, you'll be able to put that portion in inventory and therefore they'll have less expenses and higher operating income. The opposite is true for variable costing because this is not put into inventory, so you'll have lower operating income by $50,000 versus absorption costing. Okay, let's move on to number, I guess this is 10. Let's go on to number 11. Okay, J's manufacturing static budget is at 10,000 units of production, includes 40,000 for direct labor, 12,000 for electric power. Total fixed costs are 24,000. At 12,000 units of production, a flexible budget will show. So let's just start with the static budget, okay? Let's go static budget. Static budget. And the static budget says under 10,000 units, my direct labor, what did it say? It says direct labor is going to be $40,000. My electric power, which is some sort of variable cost. Let's put electric power, but we know that electric will go up with, it's a variable cost, right? It goes up with the more units you produce, the more electric power you're going to need. So that's a variable cost. That's important to understand here because variable costs will change with increases in units of production, right? And then we'll put fixed cost of $24,000. Do fixed costs change with increases of units of production? No. So we need to keep that in mind. And we'll put fixed costs here. So the idea is to isolate the variable cost from the fixed cost. And now we need to get an understanding of the cost per unit. 40,000 in direct labor divided by 10,000 units tells me that I have a direct labor cost of $4 per unit, right? And electrical power will be 40 cents per unit. So now the question is total fixed, okay, at 12,000 units. So let's say I want to make this a flexible budget. I changed my mind. Okay, I want to make it flexible. And how do I adjust this? How do I adjust this at 12,000 units? Well, that's not hard at all. Let's start with the easy one. The easy one is the fixed. Do fixed costs change with increases in units of production? No. That's why they're called fixed costs. So fixed cost is going to stay exactly the same. 24,000. These two are variable costs, so they will change. So let me just put the labels here. My direct labor, I know I already calculate what was the cost per unit, but instead of using it at 10,000 units, I'll do it at 12,000. So if I have a cost of 4,000 per unit at 12,000 units, my answer is going to be 48,000. That's going to be my new budget under a flexible budget. And you do something very similar. Electrical power at 40 cents per unit. is going to be 4,800. So do we have an answer like that? It says, okay, so I almost thought I had to start this whole video all over again. Okay, so anyways, so variable cost is, you add these two up, it's going to be 52,800, which we have here. And fixed cost is going to be, we have it in A and C. And fixed cost will stay the same, 24,000, right? Notice here how they try to trick you. That 29,000 probably is the number that you get if you adjust the fixed cost for 12,000 units, but you do not adjust fixed cost. So the answer to 11 should be C, which is 52,800 of variable cost and 24,000 of fixed cost. Okay. Okay, so let's do number 12. We got 3 more to go. Hang in there. And this video has already gone to 1 hour. It says, if budgeted beginning inventory is 4,000, budgeted ending inventory is 4,700, and budgeted cost of goods sold is 5,300, budgeted production should be. So let's take a look at this logic, right? Let's just use some logic here. It says, beginning inventory, right? We start with beginning inventory. And again, this is a lot easier to do if you know it. And it's gonna take me a while to explain it, but you should do this very quickly. So if beginning inventory is 4,000, and I produce production, and I produce X amount, right? I don't have the amount here. Oh, something happened to my mouse. Yes, my mouse isn't moving. Okay. So I don't have that number there, right? So what you have at the beginning plus what you produce is the total that you're going to have available for sale. But you're going to sell some, right? So it's telling you how much you sold. Cost of goods sold. And it's telling you that you sold a total of 5,130. And you want to have an ending inventory. So this is A minus, right? This is not a good moment for my mouse to die because I don't like using. Let me pause this for a second and fix my mouse. Okay, I'm back. I just had to put a new battery. Okay, let's do this. So I start with beginning inventory. I'm supposed to add production, right? This is the formula. This is what you produced. So you have this is the total that you have for sale, right? Whatever you started with plus what you produce, you will give you total available for sale, right? Total available for sale. Then you're going to subtract whatever you sold. And that should give you your ending inventory, right? So that's the whole logic there. And it tells you that your ending inventory is 4,700. So if we use algebra, let's put this in an algebraic formula. And I know some of you are cringing when you hear the word algebra, but it's not that hard. So 4,000 units is the beginning. You're going to add X, which is what you produce, and you're going to subtract, whatever you sold, which is 5,130, and that should give you your ending inventory, 4,700. Okay? So when we do algebra, we want to isolate the X. And whenever we put a number on the other side, we change the signs. So we say X equals, let's leave the 4,700 on that side, on this side with the same sign. If we put the 4,000 on this side, it's positive here, so we have to make it negative, minus 4,000, and the negative 5,130 becomes positive, right? Plus 5,130. And so you should get your answer there. 4,700 minus 4,000 is going to be 700, right? Plus 5,130 is going to be 5,830. So X equals 830. Okay? 5,830 should be your answer there. It took me a while to get that answer. Anybody that knows a little bit of algebra and knows this very simple concept here, which is, it's quite obvious. If you have 4,000 and you produce this much, you're going to have this much to sell. And if you sold this much, then that's going to be your ending inventory. This is very obvious stuff. If you don't understand it, just read it 3 or 4 times and you should be able to. And if you know algebra, this will be, this is how you solve it. Now there's another way to look at it, which is almost even easier. Okay? Let's look at it this way. It says if beginning inventory is 4,000 and ending inventory is 700, then what is this telling you? It's telling you that I want to produce 700 more than what I sell, right? That's common sense. If you want your inventory to go up by 700, then you must produce more than you sell. So if I want my production to be $700 greater than what I sold, I'm going to look at what I sold, my budgeted sales. My budgeted sales is 5,130. So the only way that I could get my inventory to go up by 4,000 to 4,700 is to produce 700 more than what I sell, 700 more than the 5,130. So all I'm going to do is I'm going to take ending inventory, subtract beginning inventory, which is 700, and add it to the cost of goods sold. And I get my answer, 5,830, okay? And that should take you a good 30 seconds to solve this question. Let's and if it doesn't come that intuitively, then just try to follow this logic, okay? We got 2 more to go. 13. Okay. Good Eats Inc. manufactures flatware sets. The budgeted production for 8,000 sets The budgeted production is for 80,000 sets this year. Each set requires 2.5 hours to polish the material. If polishing labor costs $15 per hour, determine the direct labor cost budget for polishing for the year. Okay, the basic premise is that of this type of questions is to let you know that everything must make sense. You can't make a budget where you have budgeted production hours, budgeted labor cost hours, and then you do your direct labor cost total and it doesn't tie in. Everything must tie in perfectly. It must make logical mathematical sense, okay? So if I have 80,000, let's start here. Budgeted production the budgeted production is, okay, so this is units. Okay, this is the first time that I see this one. So I have 80,000 units that I want to produce, right? And it's telling me that each of these units requires 2.5 hours, right? So each unit is going to take hours per unit, hours in labor, right? We're talking about labor hours per unit. Okay, so labor hours per unit is going to be 2.5. So how many total labor hours do I need to produce 80,000 units? That's very simple, right? 80,000 times 2.5 is 200,000. So this is total labor hours to be budgeted. If we want the budget to make sense mathematically and tie in, I must budget 200,000 labor hours. But that's not the question. The question is the labor cost. So how much do I pay per hour? 15,000, right? Labor cost per $15. So labor cost per hour is $15. So my total labor cost is simple to calculate, right? I have budgeted, I need 200,000 hours to produce my 80,000 units that I budgeted, and each hour is going to cost me $15. So my total direct labor budget, total direct labor budget is going to be 200,000 times $15. And it's going to be 3 million, as you see up here. That's your answer. That's how you come up with it. So let's go with the last one. These are 14 problems which are pretty close. Not exact, but they're fairly close to what you're going to see in the exam. If you know these 14 problems, you should have 14 answers correctly. And then the rest are more conceptual. Go through the review that I gave you and look for all the answers in the review. And you should be able to get an A if you get all this, okay? So what's the next one? The next one is a company is preparing a cash budget, okay? Its cash budget, its cash balance in January is 290 and it has a minimum cash requirement of 340. The following data has been provided, okay? What is the amount of the deficiency or excess cash after considering the minimum cash balance for January, okay? So this is just common sense. Let's forget about February and March. It's not part of this. It's asking for January, right? So it says it's cash balance on January 1. So starting balance, right? Starting balance is starting balance is 290,000. And then it says you're going to receive, so that's a plus, right? Let's put that there so that to make it clear. So you're going to receive 1,061 1,061,200, right? This is cash receipts. and then cash payments. Do you add or subtract, right? What do you do with that? Obviously, these are cash payments, so you're going to subtract. So you're going to go ahead and subtract your cash payments of 984,500. 984,500. So this is the total cash that you will have. We're not finished yet. So your total cash is, you started with 290, you add it with receipts of 1 million, but you paid 984. So that's what you had. I'm sorry, what happened here? And you paid 984, right? This plus this minus this is 366,700. However, it says you have a minimum cash requirement of 340. Okay, so that's cash that you have to have in the bank. So let's go ahead and subtract that because you need to have it in the bank. This is not excess cash. So minimum cash requirement is 340. So then the question becomes, am I okay with my cash balance at the end, or do I need to borrow money so that I could comply with maybe the bank? I have an agreement with the bank to keep $340,000. So if I'm short, I probably will have to borrow money, right? So that's the question. But as we can see here, we're more than fine because we have 366,700. It covers our minimum cash requirement of 340, and we have excess cash of 26,700. So the answer to that would be A, excess of 26,700, right? It says, what's the question? What is the amount of the deficiency or excess cash after considering? So we have excess cash of 26,700. Okay, so those are samples of all the types of problems that you're going to have in exam number 2. If you understand all these problems, you should be fine. Like I said, go through the review to get more of the conceptual type of questions. Let's see, just for going through all this, I'll give you a little bonus here, just for reaching the end. Accountants prefer variable costing method over absorption costing method for evaluating the performance of the company because, why? What's the logic here? Well, the logic is, if you remember from the PowerPoint slides, that if you use absorption costing, you could increase your income simply by producing more inventory. Why? Because if you produce more inventory under absorption costing, you'll be able to allocate more of your fixed manufacturing overhead costs to inventory, and you'll be able to put that into inventory and not expense it, right? So that's one of the reasons why variable costing is preferred over absorption costing, because under absorption costing, income could appear higher just by producing more inventory. Okay, that might come in the test. That's a little bonus for listening to the whole video. Okay, good luck. Thank you.